Please welcome the panel on Credit Outlook, moderated by Chairman of the Milken Institute, Michael Milken.
Well, good morning. Good morning. It's May 7th, 2024, and we are here on the credit outlook for the entire world. And these four individuals, at least for the next hour, will be the leading credit investors and analysts in the world today. And you will leave much more educated than you did when you arrived. So if you read the description of this panel, what were the lessons learned over the decades? Where do we believe the market is headed next? What appears compelling today and has potential for tomorrow? And finally, what more can be done to keep capital markets accessible and ensure prosperity for all? So those are some of the things we're hoping to achieve today. And more than anything, we want you to try to understand these organizations, what they do, how they operate. And so we're going to start in a little different trend today. For 20 years, we did not allow any visitors on our trading floor between 6 in the morning and 2 in the afternoon. I viewed it as a distraction and decreasing our productivity. This group is going to do something unique for all of you. They're going to let you come inside their investment process. How do they make investments? What are the decisions? How does it work internally? How do they review their investments? How do they decide the size they're going to take in investments? And we're going to start with the world's largest money manager, BlackRock. And so, James, why don't you start us off? How often do you have your meetings? When are you deciding to do? How does someone get their credit accepted by you so you invest?
Thanks, Mike. Yeah, I would say, obviously, at BlackRock, we run a variety of different strategies and solutions, and we actually believe in the value of the overall platform. One, to produce alpha and solutions for our clients, but two, inside the investment process, that information, breadth of solutions provides value across the aggregate investment process. So from a starting point, obviously, we're trying to figure out what is the outcome we're trying to achieve, right? What is the alpha source, the parts of the market to create a solution or achieve an outcome from a return perspective in the overall market. And everything generally aligns to that, right? So then that feeds into the portfolio construction, what we want to originate, and obviously we want to scale the breadth of that origination. So at BlackRock, with the reach that we have across public and private companies, sponsors, that obviously feeds into a wide range of opportunities that we can decipher to fit and best achieve the outcomes in that goal. So that's the starting point, right? And then each one of those deals that come in or opportunities, we're running through our diligence process, right? And that we are obviously analyzing like everybody else to try to find out the merits of each one of those investments and how that ultimately may fit that outcome or the resiliency of that outcome. And from an investment process standpoint, we want to challenge that with data analytics, investment experiences, and so we have a broad range of people that will participate across the firm. And if there's a domain expertise that exists around the institution on the equity side, on the fixed income side, by region, we will seek that out in order to enhance our investment diligence associated to that. But every one of these deals, as you try to forecast out what might happen in the next 3 to 4 or 5 years, ultimately you're going to have risks associated to that. And that entails a lot of the structuring of that investment and bringing the workout capacity and the legal capacity up front to understand, how do we ultimately want to mitigate those losses or mitigate the risks associated to any one of those, really kind of is circular in its path. So how we think about that transaction, its fit, and ultimately what will go through the investment committee to fit that goal is all done on the front end side. Pro forma, once we make that investment decision in the committee, that's a very kind of active monitoring across the life of that investment. And I think what's important is that these investments are not just done in chronological order, right? At the end of the day, as you start to fill out that fund, is trying to really understand every new investment or how each investment in the fund are acting. What does that mean to the correlation of the aggregate fund, right? And how are you thinking about exits? How are you thinking about new investments that come in? Because at the end of the day, all of this is trying to build to delivering that expected outcome that aligns to what your investors came inside. So it's very fluid throughout that. It's very active. I would say our investment governance includes people within our investment team, also other expertise that exists outside our investment teams within the firm to really challenge that and protect against, I would call it deal fatigue, right? Where somebody's done 6 months worth of work on something but wants to get it in, but ultimately it starts to soften up with regards to term structure or pricing, and that ultimately is something that doesn't fit. So we end up closing on about 2 to 5% of the deals that we see that go through the investment committee. And I would say that same process runs through all risk spectrums and all types of investment process across corporate, real estate, infrastructure, and other assets.
All right, and the key point I just wanted to reinforce here, when you think of venture capital, quite often they'll say they look at 100 and invest in one. In this case, in credit, you have a similar situation where you're saying 2 to 5% of what might be in the market you choose to invest in. Victor, take us inside how Strategic Value Partners is operating.
We live in a different part of the world. We are in the much higher risk, much higher return spectrum than probably most of my friends here on this panel today, right? And in over 22 years at Strategic Value Partners, we built a process with transparency, with collegiality, in some respects, it's a little bit, Jim, like kind of what you have in a lot of respects. But I think I would just highlight two things in addition to it. In our world, when you are investing, you've got to it's all about, there are two things, more than building the investment thesis. And there's a lot of work which goes into it. There are two things which we find incredibly important. One is sourcing debt. In our world, we buy stuff at 40 cents, 50 cents, 70 cents of face. And in that debt sourcing business, there are Wall Street investment banks who are often the intermediaries in sourcing that debt, and they're really good. But what we find is we have to really supplement them dramatically to be able to go buy enough debt to be able to go take control of a company. 60, 70, 80% of some of the deals we are buying debt directly from the banks. And by the way, there's value when you kind of do that. The second place where it comes into our investment process, the businesses we are often investing in are good businesses. But the owner of the business, the private equity investor, has often given up. And at the same time, some of the good management teams who kind of run these businesses, some are still there, some just leave in the last 2, 3, 4 years because their MIP, their management incentive programs, aren't really worth very much. So when in our investment process, you've got that core piece, the investment thesis part, where there's a lot of work done, lots of consultant hires, there's the grind, there is the iteration. The sourcing piece of it, there's magic to it. Our world is inefficient. In the operating piece of it, look, There are 14 out of 15 businesses where we have majority equity control today. And 14 out of those 15 businesses where we have control, we have more employees than when we took over. So our processes, we are trying to rebuild these companies. And my gosh, I think more often than not, much more often than not, we are succeeding.
Mark, take us inside Blue Owl Capital. You've built this firm in a relatively short period of time, but you have individuals who knew each other for decades. I'm walking in the day you're making decisions. What does it look like?
Thanks, Mike. 3 questions. What can go wrong with this company? Second, if it goes wrong, how far wrong does it go? And third, if it goes that far wrong, do we still get our money back? I mean, at some level, the rubric's very simple. The process is obviously very involved. But in the private credit world, and I love having the opportunity to be together with such leading figures in credit, because there's so many elements of this credit landscape. And as Victor just said, he's looking for those, so to speak, fallen angels that are owned, someone's given up on. We're coming at this credit world from a very different lens. And one isn't better, worse, or otherwise. There's the private world, there's a liquid world, and I'm sure we'll talk about it. But in our process, it is about going out and finding those companies that pass the 3 tests. So what does that mean? My co-founder, Doug Ostrover, is very fond of making this shape in the office. And that's the funnel. We've looked at about 10,000 different companies to make the 500 loans we've made. And that is an involved process because we're doing private side work. That means weeks or months of work on each company. We have 120 people that spent every day, all day, waking up, to use the old Dunkin' Donuts, making the donuts. I mean, it is a very scale-intensive, work-intensive process. Find those companies and do the work to answer those questions. And that's all about talking to customers. It's talking to suppliers. It's knowing the ecosystem. We're the largest lender, probably in the world on the private side, to software companies. So we know the companies, we know the people they work alongside. We can talk to their peers and competitors and hopefully make, therefore, a really informed choice. And that's allowed us to look at 10,000, invest in 500, and by doing that, though, deploy $100 billion in capital. And do that while maintaining only a 7 basis point loss rate. So for us, it really is about, at some level, a very simple framework, and then a really, really deep dive, and then proving an enduring partner to those companies we finance.
Purnima, okay. JPS also has built substantially over the last decade. You're a governing partner. We're going to walk in your offices. You're nice enough to let 1,000 people join you today in the meeting. What happened in your meeting?
There's a little bit of similarities, I think, with Mark, but I think there's 3 things. One, does this business need to exist? So let's start there. Number 2, let's make sure that we have enough of, margin of safety for something to go wrong. So we're not pricing something to perfection necessarily. We are trying to make sure we're protected on the downside because that's most important in the credit world. That could include stressing cash flows, stressing revenues, stressing interest rates, coming to a view on LTV, making sure the structures are sound and tight enough to protect you along the way. And then the third is, where does this asset go if we like it? What's the right risk box, and does that answer the need for what we're trying to accomplish for our investors? So I think those are kind of the way that we start to approach something. I think with regard to the funnel and the opportunity set, you'll hear these numbers of sub 5% from everybody. I think one thing at HPS that's important is that several of our flagship strategies actually are going after the non-sponsor world. And so there's a lot of analysis done on industries and where do we want to sit and getting to know management teams and helping to support, in many instances, growth in those businesses. So that's been a big differentiator, I think, from our standpoint. And then the last thing I would say is on the theme of protection, we have found for our business, controlling a tranche has been a huge help in terms of protecting returns and getting your money back if something doesn't go exactly the way that you want it to go.
All right, James, let's get back to you. So what do we see in the market reflecting today? Tightening spreads, rising default rates, higher for longer interest rate environment. How do you think investors should be thinking about credit today?
So I would say some of the thoughts around credit historically, I think for all of us, probably the question we always get most often is like, where in the cycle are we? And I don't necessarily think that's the right question. I think there's also a question about what does the cycle look like? What's the breadth and depth of it? But from a credit perspective, obviously, there has been a big shift in the market. Obviously, as we came out of the pandemic and you had the policy response to the inflationary pressures, and over the course of the last 18 months, I would say the range of outcomes of uncertainty around the level of inflation is narrowed. And so the debate around the corresponding policy has tightened up in its range. The corresponding growth expectations have tightened down in range, and you've seen volatility collapse across the board. As you mentioned, Mike, obviously spreads have tightened. If you look at higher quality credit spreads, and let's just say in the levered markets, things that would equate to kind of double B or single B type risk, they're at their tights of where they've been for the last 10 years, or within the top 10 percentile of that. So dispersion is a very key theme that we see in the market, and we see that evolving kind of throughout. It doesn't necessarily mean there's not a tremendous amount of value in the market. It just means that the alpha sources or the credit selection are going to be really important, both in the public and private markets associated to that. And so how does that play out? Obviously, that higher for longer dynamic, the quick move in rates, certainly when you think about a lot of the private credit market or the broadly syndicated loan market, positive was you had a floating rate instrument that obviously protected against that negative duration move that you saw a couple of years ago, or the volatility that you see today. The negatives are obviously interest coverage ratios have declined fairly rapidly across the space. And so you're seeing companies that have to adjust to that, right? It's a new rate regime. Companies have to really adjust, and that's going to, I would call it, cause a fair amount of dispersion. You see that in the corporate space. As you've seen defaults start to tick up, as you mentioned. On the private side, you see covenant defaults stepping up as well. These are generally still benign and generally offset by the positive impact of most of your portfolio having a higher yield associated to it because of the base rate effect associated to that. So it's been a pretty good environment, and I actually think, from an aggregate standpoint, you should not necessarily think about it as a cyclical component. A year ago or 2 years ago, you might have thought about some of the positives of floating rate instruments were just to avoid the negative duration risk or the risk of duration moving. Now I just view it as a core part of your portfolio, right? The diversification you can get in the private credit space across different industries, different names that remain public on the private equity side, different risk factors like illiquidity premiums, complexity premiums, things like that don't necessarily correlate to the public market in an aggregate portfolio are very accretive to the optimization framework of that. And so we see private credit as a whole increasing within most people's portfolios, largely because of the diversification and the yield premiums you can get. And from a real short-term perspective, even though you've seen a flatter curve as inflation has become more complex at these levels, you still have an inverted curve. You're still getting high single digits to low double digits type yields on most income product, even net of defaults if you were to just look at the beta instrument of that. And from a capital market assumption standpoint, that still looks very attractive to most fixed income assets as well as equity markets over the next 5 years.
Thank you. Victor, you've been a credit investor for decades, have lived through multiple cycles. We had pulled back up that inflation slide going back to 1970, looking at 50 years here. And I've often, said at these sessions over the year, the most important period to look at was really this first oil shock in 74, and you had debt trading for its coupon. I never thought in my lifetime I would see the ability to buy debt that was currently paying interest. You'd be able to buy for its coupon, but in 2009, for a short period of time, we had that opportunity. What is your view on the credit opportunities today as you look for companies buying their debt where you can add value or become their largest stockholder?
We think it's I think Jim sort of was describing it well. We think it's a good environment today for making new credit investments as you kind of look forward today. But hey, it forgets those pesky historical portfolios, right? There's $4 trillion of private equity investments in the ground today in the United States. There is, between direct lending and high yield, there's $4 trillion of credit investments in the ground today. So I think the view we would have is, sure, looks all good, looks reasonable as you go forward. But my God, from our standpoint, it looks like these ducks sedately gliding across a pond, and underneath, oh my God, we see what's going on, right? And look, starting about a year ago, this is not something like, hey, it's going to happen next year. Starting a year ago, we started to lean in, right? And look, it's very straightforward. You've got outside tech and software in the US, you've got a sluggish economy. In Europe, which is about half our business, you've got near recessionary conditions. So companies can't grow cash flows that well. You've got high rates. You've got a maturity wall. 24 is okay. 25, 26, 27 is $600 billion a year. And my gosh, there's only, look, the private equity guys, and we are one in a way too, everybody is very good at wiggling, right? We're going to wiggle as we deal with these maturity walls, right? But I think our sense would be, and it's represented right here on this platform, there's a really interesting, I think 500 billion of this stuff is going to require some very adventurous financing, which everybody here will be happy to provide, right? And at the same point in time, to our point of view, there's another 300 billion or so where people will just say, had enough fun with it, right? And I think, please, I'm not here trying to predict some great crash or something. Don't think there is one. But my God, in the private equity business, in the high yield direct lending business, we've just signed up for a multi-year slog.
So let's take a look. I used to always say, let's take a look at the secondary market. So when you think about the automobile market, and we're all going to be driving electric cars, what about the 100 million, 200 million cars that are out there in the secondary market? And what you've done here is you say, well, gosh, there's 8 trillion. My guess is that might be understating the amount, but let's say there's 10 trillion out there today that you have a chance to go out and look at. You don't need the new issue coming down the track. And I do think, Warren Buffett told us about when the tide goes out, we'll see who's wearing bathing suits. And you've told us that the ducks might look casual above the water. Victor, we're going to create a slide next year, for you particularly, and show how hard they're pedaling under the ground. Mark, what do you think about the relative value of private credit today and the structural protections you have to try to put in place? Obviously, there was a period of time when there were no covenants, and today people are much more focused on covenants. What is the relative value you see today?
So let me pick up on what Victor was just talking about. There's another very large piece of that puzzle. We just talked about the 500 billion, the 300 billion. Then there's the trillions that are, in many cases, perfectly good companies that need to be financed with long-term solutions. And that's why I think one of the greatest misunderstandings, or I'd say misperceptions, of the private credit market, it's not the golden age. It never was. it's a renaissance. It's really about a evolution of a market, and it's really about building an adjacent solution that meets a need. And if I could, Mike, I'd have to digress for a second. It's such a unique privilege to be here, because when you were inventing these markets that we're all talking about, when I was aspiring to be Alex P. Keaton, for those that understand that reference, back in the 80s, you were inventing this business. And to be here today and talk about private credit, and it's a renaissance, and I sort of think this metaphor holds, because Renaissance was built on reattaching to the great ideas and insights of the past and moving them forward. And gosh, people like to say it's a new market. It's a new incarnation of a market. You invent it. It is about providing credit, but it's got some twists. And the twists are that it's about matching long-term capital to long-term needs, doing that with very, very deep due diligence, and doing that in a fashion where the documents, as you just said, where covenants matter. The credit, I would actually argue the loan agreements and the way we write them and the partnerships we provide to the borrower are much more valuable than the question of the incremental spread. Thankfully, we get both. But the result of that is we're talking about a very durable answer as part of a growing, vibrant capital market. So it isn't a moment in time. The problem with the golden era idea is eras start and eras end. And I think this is actually much more about an evolution than, frankly, you started. So
why don't we pull up slide 7, Mark? Maybe you can see how that links to your thinking. Here. That's slide 8. Go ahead.
Yeah. So I can, yes, great. So this is not my data. This is third-party data. And I think the point that we can see here, and then I'll flip to the next slide in a moment, is about the ability to generate premium, but the ability to generate premium in an enduring way. So here, as you can see on this slide, even if you start taking the default rates up quite substantially, and by the way, like in our portfolio, and I'm not doing a blue owl advertisement, but we're way below a 1% default rate. I mentioned we have a 7 basis point realized loss rate. So there's a long putt from here to this so-called expected average. And that is one heck of a risk-adjusted return. To be a lender through an average in our portfolio today, it's less than 40% of the value of an enterprise. So again, that's not saying it's the answer for everything. It's not saying there aren't going to be credit problems. There are going to be plenty of credit problems in the world, and Victor are going to solve them, and Jimmy's going to trade them, and there's going to be a lot of great work that HPS is going to do because they've got as broad a credit set of strategies as exist in the world. And so, I don't think it is a one-size-fits-all, but what this tells me is there's a durable, powerful role for direct lending in the marketplace. And if we flip the next slide that was just up, it's not new. This is the Renaissance point, right? It's not new. This idea that you can earn a premium for delivering a value-added financing solution is not a new incarnation. It's a new version. It's a new rendition. And I think it'll be an enduring part of this marketplace.
And Mark, if I could give an advertisement for the three of you, right? So the syndicated market, the high yield market, doesn't have any ongoing covenants when you go do an issue there. The direct lending people, almost to a fault, have covenants. So look, we are also, we buy debt, we restructure stuff, we lend money also, some very expensive money, right? But when we borrow money, the first choice we have, we'd rather go to the syndication market. If we can't go there, we have borrowed money from some of the people right here on this panel, right? They're efficient, they're good, and my God, they have covenants. And they are following you religiously, right, when they kind of lend money.
Purnima, private credit has had this significant growth. We put a slide up showing you how fast it's grown, not just in the United States, but around the world, but particularly in the United States. And a focus of, is private credit taking market share from liquid markets, other markets? You've been a large provider in both markets, both private and public. What do you see as the interplay between the two of these?
I think you're hearing a little bit of a theme here, which is just to level set, the liquid markets are roughly $2.8 trillion. The private credit market for direct lending is about $1.5 trillion, and people are expecting it to be basically where the liquid markets are in several years. So I think that those markets there's been an ebb and flow, and they're kind of symbiotic. So the first is, in the last several years, the capital markets have been shut down, the liquid markets have done a lot, and guys that are bigger have been able to really come into play with companies that normally would not access the private market. So I think there was, in the last 22 and 23, $140 billion of paper that was done in the illiquid, in the private credit markets, over $1 billion tranche sizes. So these are big businesses. This year, that trend has flipped back, and the liquid markets are open, and there's a lot of refinancing happening. So I think one is that these markets do coexist. I think they coexist in two dimensions. The first is when the markets are dislocated, the capital markets for borrowers to access the syndicated market. And the second, though, which is far more consistent, is there is a segment of the liquid markets which are not really accessible to the liquid markets, which is the B- market. So the majority of the liquid market likes a box. They like a clean risk box, a single B and above. That's great. CLOs finance 60% of it. And you've got a big portion of that market, 15 to 20%, depending on your numbers, that's B- and below, which I think is an interesting market for the private credit market. So that's kind of one thing. The second thing I would say is, people are very focused on this default issue. I think one of these slides has it, but the loss rate is actually the most relevant. And I think historically, people have viewed the private credit markets as a illiquidity pickup of, pick your numbers, 150 to 250 basis points. I'm not sure that illiquidity pickup isn't mispriced, actually, because what they're not accounting for is, what's going on in the liquid markets now, where, the game has changed. So what you used to think you had in a risk box is not necessarily the case. So there's, recoveries in the liquid markets, if things go sideways, are 30 or 40 cents now for investors. And if you think about the math there, any 1% change in default rates, I suspect private credit, even when things go wrong, is at least 100% higher, if not more. So if you now are saying, well, the liquid credit guys, if you have something go wrong, are returning 30 to 40 cents, 1, 2, 3, 4, 5% of the time, pick your number, that is a huge drain on what your overall yield is. In the private world, that recovery is much higher still.
Let's address the slide here that you put up and really kind of talk about the detail of it here.
Yeah, so this is a slide which shows a number of deals. I'm looking at the slide down here. It shows a number of deals where the press has referred to it as creditor violence. I think there's just the coordination cost. You can put any kind of nomenclature around this, but the short version of it is there are two covenants that people generally take advantage of. So there's a whole slew. There's a 100-page document. Doesn't matter. There's two things that matter. It's how much debt can you put on top of someone, and how many of your assets can I take away from you, even though you think you have them. And those two things have created a real bifurcation in terms of the existing lender groups, and people like Victor are able to take advantage of that. And that bifurcation has created those investors that are left behind recovering really low recovery rates. In the pre-crisis time, pre-2008, pre-GFC, people always said, oh, it's 2% default rate and you'll return 70 or 80 cents and the cost of the default won't really matter that much because it's 20 or 30 basis points. Even if defaults go up a lot, it's not going to be that big of a deal because you still get 80 cents back, so maybe it's 100 basis points, so we can sort of band it. You can't do that when you're returning 30 cents. There is, you can't have 2% defaults and lose 70 cents. Because all of a sudden you're losing 20% of your return. That math doesn't work anymore. So I think the thing about the private and the liquid markets, what does all that mean? I think there's two things that it means. I think the first is that, now this is a biased comment because people on this stage have a very similar theme in terms of controlling a tranche. But the benefit of control is the protection on your loss rate, because you do not have the coordination cost with 100 other lenders. And that is a huge amount of value that I think is being underappreciated. I think the second point in the liquid markets is what that all means is, turns out 8 to 10% is pretty good. And you don't really need to take the tail risk of defaults and reach for 200 or 300 basis points higher. So you can live in double B land, and you can live in that single B land where your risk of this is much lower and generate 8 to 10% and not reach for 12 to 14% of the liquid land. So I think those would be the two takeaways.
Why don't we take a look at another slide? I'll go right back to you, Mark, that you had, and there was a previous slide, I think it'll be your slide 9 here, possibly, of your slide showing compelling yields across liquid and private credit, not that one, maybe the, looking at these different slides, that's not it. Is there either? So you gave us a slide showing a step building here and the issues of looking at it as generating rate of return, where the top of your pile was directly originated, upper middle market, non-sponsored loans. Why do they, in your view, give you the highest rates of return?
So there can be a number of reasons. I think there's a few that I would just point to. One is that, so in the liquid markets, again, we kind of talked about a clean box. People in the liquid markets like a box that they can understand. So maybe it's a first-time issuer. So that would be one. Two is a lot of private companies, they want what is referenced as a delayed draw facility. All that means is capital to grow. That can be capital on the senior side, it can be capital on the junior side, but capital to grow. So over the history of time, companies don't usually stay stagnant. They need to grow over time, so they need to borrow money, either get debt or equity to continue to fund their business. So delayed draws are not customary in the liquid markets. People will pay for that certainty because over time, I think my partner said this yesterday in his piano, but over time, over a long period of time, people need to access the capital markets. At some point over 5 or 10 years, the markets may not be available to you. So there's a slight premium people might pay for that. So that's two. Three is if that rating at a current moment in time may not be a rating that the liquid market likes, if it's a B- or below, and you can see that in the spread dispersion. I think, James, you mentioned spread dispersion in the liquid markets. You can see it. That will command an incremental premium. And then 4, people pay for things like portability, like PIK flexibility if there's a little bit of stress for a moment in time. So there's a number of reasons folks might actually pay a little bit of a premium that are non-sponsor oriented.
All right, so there were 2 points I'd like to emphasize that have been made. One, covenants might be more valuable than spread. And we have a relatively young panel here, but in W.T. Grant, we had a situation 50 years ago where one debt issue got 100 cents on the dollar and the other got 0. So, Mark, you wanted to follow up on a statement here, but I want to throw that idea out to the panel of how important covenants are from this standpoint. And 2, default rates. The studies that looked at what happened during the Depression, a very difficult period of time for a long period of time in our country's history, showed the lower quality of your portfolio, the higher rate of return, even during the Depression. But are we seeing a change in default rates, recoveries here from that standpoint? And so, as we just heard, it's not the default rate, it's the recovery rate that's driving your rates of return. And you might remember Texaco went bankrupt because of a ruling in a Texas court. The equity was worth more than $10 billion, but they did it for legal reasons, so you had more than 100% recovery. So maybe we could just, Mark, I want to let you go first here, but we could just touch on your views on recovery rates and your reviews on covenants today.
Thank you. That's exactly what I wanted to amplify with Purnima's good observation. It is all about recovery. First, it's about getting the credit right, of course, but when, and hopefully it's rare, when that gets off track enough, it's all about the recovery. And I made the comment before that, I think the document is actually more valuable than the incremental spread, and I think better put, as you just did, Mike, it's really about the covenants. It's about your ability to control the box. It's about your ability to make sure that, first of all, bad things don't happen to you. That is to say, the incremental debt, perfectly well said, the layering. mean, I did private equity for 21 years before doing this. LBOs, and of course, Mike, having helped create KKR and the opportunity, I was at KKR for 21 years. And I can tell you what we did to those credit documents in order to create escape hatches left, right, and center. And my partner, Craig Packer, who runs our credit business, he makes this statement, and it is approximately true. Our weakest document is better than the strongest document in the syndicated market. Now, obviously, there's going to be an overlap in those tails somewhere. But on average, those are a wide dispersion. And so at the end of the day, I think it is all about those recoveries, because we want to pick companies that don't get in trouble. But when they do, we want to get most of our money back. And by the way, that has worked. The recoveries, and Purnima put a good estimate to it, they might be double the difference. And it's all the difference in making the returns in private credit. And I would add one last feature, kudos to actually, in this case, to the private equity industry. As sponsors with big pools of capital, if you have a simple enough capital structure and you have them in the box, it's a pretty easy answer to a default and a recovery. Put up some more money and keep your asset. And 9 out of 10 times during the pandemic, which now all looks like it's in the rearview mirror, but during the dark days of zero revenue, people put up money. And that's what a tight box can get you, and that's a way of getting a great recovery.
So I just want to comment on that also, Mark. A covenant might not just be a credit covenant. In the case of Home Depot Supply, a Carlisle company, they loaned money and had a non-call. So the non-call covenant made the debt worth 160 cents on the dollar. And so when you buy a 30-year U.S. government, and if it's non-call, interest rates go down, you have significant appreciation. So the importance of reading and structuring, and in the marketplace, I think, Mark, as you've discussed, when you were sitting at KKR, obviously you were very focused on the covenants giving you freedom. And I think if you sat at many private equity firms over the last 40 years, they would have paid you a higher rate for more freedom. Today, people are looking at things with a different eye, and that's a little different. I want to go back, if I could, just for one moment to you, Victor. And I want to be able to invest when you take your position, so you and your firm do all the hard work, turn the companies around, bring in management, create value. And so I'm excited about what you own. Let's take a look, if we could, at one case study. If we could pull up your slide here and look at the Swissport deal. Okay? Let's see if we could take a look at that deal.
Swissport is, can I tell you, even before I start, as you hear me spend a few minutes on Swissport, and please, nobody should be offended, we can't even feel 100 basis points in returns, right? Whether our returns are going to be X or X plus 100, just can't even feel it, right, as we kind of make investments. Swissport is the largest baggage handling company in the world. I know we've lost somebody's luggage in here, I'm sure, right? But it's, and in COVID, and I think as you can appreciate in COVID, everything shut down, airline flights shut down, and Swissport ended up, it had a sponsor, not quite like the kind of sponsors you back, Mark. It had a sponsor who couldn't inject new equity into it, and they decided they were going to kind of walk away. But even as all this was going on, the house was burning. They had 50,000 employees. They went down to 12,000 employees at the depths of COVID. And for somebody like, and this is a business which these guys had bought for 3+ billion euros. When we looked at it, we saw, to our point of view, we ended up buying a lot of senior debt. So today we have almost half of Swissport equity. We own about half of Swissport equity today. We ended up buying a lot of senior debt. We bought it for about 70 cents of face. There was 1.5 billion euros of senior debt. So a company which these guys had bought for 3 billion, we bought for 70 cents of 1.5 billion. But look, so we bought it, we restructured the balance sheet. Hey, all very reasonable, straightforward things when the sponsor gave up. The hard work is what you see in the charts. You know, when you end up buying Swissport at this moment of time, you've got to go out and rebuild the business. We went out, and today, 7 of the top 10 people are new. There's a new chairman, there's a new CEO, there's a new CFO. We've really rebuilt the management team as part and parcel of kind of taking over. And by the way, when you look at the chart of the EBITDA trajectory, it looks like ducks gliding on a pond. Don't get the wrong idea, please. Do not get the wrong idea. 2022, we had our moments. But I think today's Swissport has 60,000 or so employees. It's gaining market share again. It is a multiple size of the next largest competitor. But I think to do an investment like this, we had to source the debt piece by piece to be able to own enough to have that kind of a position. And we had to own enough. Mike, and please don't be offended, we can't really do these deals with 5 owners, right? You've got to have enough voting power to be able to kind of drive a bunch of the operational change. We work with some of the owners. Some of the other owners are good, right? They've been helpful, but we need to be able to drive it, and that's kind of what we've done with Swissport.
So, Victor, I would worship the ground of you investors if I didn't have to get involved when something goes wrong, okay? So there are many of those other partners that are happy to give you the leadership. I want to just look back a little differently here, and if I took you back to the 1960s, what I was thinking about was that less than 1/10, less than 1/100th of 1% of all the companies in the world are investment grade. So what about the 99.99% of the companies? And I think one of the issues in many cases was the separation of ownership and management. And so in 1969, I got a chance to meet the chairman and CEO of Penn Central, and he was really most focused on his image, and it was hard for his team of 20 to build his image when they went bankrupt in May of '70. You had to have a trading market to take the size of the market, James, that you can invest in, okay? If you need the size of BlackRock, you have to be able to buy and sell, and Victor, you told us, if you have an idea, you have to be able to buy it, and Mark and Pernina, your firms have grown so quickly, you need a market, and if you ever want to sell, you need a secondary market. Third, you needed issuers. Now, you've just told us, if you're only buying 500 or 10,000, you got plenty of issuers. And lastly, you need enough investors, so one investor, just not one of you, is making the decision. And next, you needed securitization, because it's hard to be biased if you don't even know who you're lending money to on a car loan or et cetera. But as we look at it today, let's take the real estate market. I could have made 100 mortgage loans, and at the beginning, if you don't pay me, hand me the keys. But I'm not capable of managing that office building, nor can I rent it up. And so whether you're 1%, whether you're 2%, there is no matter how great investor you are in the world, that's going to have 0 problems in their portfolio, unless you're willing to accept rates of return at U.S. government rates. So let's start with BlackRock. How are you equipped when there's a challenge in the portfolio?
Go back to I think just to come back to the numbers, right? I mean, a lot of what we've been talking about is kind of performing or direct lending when we say private credit. I think the private debt markets are going to grow and evolve over the course of the next 10 years, right? So some of the numbers that we quote in the growth of the overall market, some of that just came from growth of GDP, growth of EPS, right? The S&P earnings have gone from 50 to 230 plus over the course of the last 20 years. And so in general, things have scaled up. I think regulation is evolving and changing, and Basel III will create a wider range of opportunities for both the public and the private markets to grow. So when we say private debt, I think that ecosystem is going to evolve beyond corporate direct lending and real estate and infrastructure types of ABLs. It's going to just continue to scale up. So I think it's really important from a platform standpoint to be able to align that. And to your question, Mike, is how are we equipped? There are two sides of that. One, when we are creating assets, right, not buying in the secondary, it's really important, as I said before, of structuring that up front. Things are going to go wrong, certainly in an asset that might be illiquid, have private information. You're trying to forecast both the macro and the micro. And if you have a diverse portfolio, the reality is some of those situations are going to happen at the company level or simplistically at the industry level, or as Victor pointed out.
Mark, let's put up the slide on rising reserve rates for banks, because it's a point you're making here.
And so on that part, it's really important to have that structuring up front, right? As Victor kind of outlined is, in some of the secondary markets, right, as the documents, we now move to a covenant light environment, documents have gotten weaker, there's a lot more flexibility to kind of restructure companies outside of a Chapter 11 process, or more of these LME exercises in order to kind of gain control or structure or change the dynamic of the risk-return profile of the waterfall of first liens to unsecured assets. You have to be able to analyze that in the secondary market, right? Because you're given a document and trying to understand that flexibility or risk that exists not just in the company's earnings, but also within the documents and the structure, because you can be right on the company and wrong on the structure. I think on the private side is a little bit different. You're trying to forecast that out, so really bringing in that kind of workout and distressed knowledge up front to understand of if something goes wrong, how do I ultimately protect yourself? Because you're not going into that trying to forecast the default. But if it happens, you want to be able to, as Mark talked about, be able to re-engage with the owners of that business, the management team, the board, the sponsor, to basically say, okay, this is not what we underwrote. What should we be doing here, right? And that business may need to restructure its balance sheet based off of that new kind of growth paradigm. And in some cases, that might mean they shift OpEx or CapEx and start to pay down debt. In other instances, you might have an equity infusion, or what you have seen a lot in the last 18 months is more tuck-in acquisitions that over-equitized deals are getting brought in and post-synergies. That's deleveraging the company. Or in some cases, that might mean you need to restructure the loan, the docs, but the company can't necessarily exist with a new level of earnings and that high debt burden that exists on the balance sheet and still be competitive, right? And so in the private market, I think it's really important to have that upfront structuring, but also have that monitoring and engagement on a pro forma basis on that. And so it's a very active dialogue. On the public side, it's a little bit different, right? And I think that is the lack of structure and documentation is really allowing for more of this. And I think the defaults that you showed, or you showed, if you think about pre-2020, about 10 to 20% of the stated defaults were kind of distressed exchanges. Now it's at about 60% of the stated default rate, right? So the looseness in documentations is allowing for management teams to engage, to change the structure of that business, to buy them time, but it doesn't necessarily mean it's creating a healthier business or franchise. So you're seeing more repeat default issuers associated to that. And what that is coming at the expense of is both the equity, but in many cases, some of the debt holders with regards to their potential return profile.
So if you assume today when I throw in term loans, public, private, et cetera, maybe there's $7 trillion out there in some sector of this market around the world today. But when I put up that capital, if the banking system worldwide shrinks by 10 trillion, okay, because of regulation and because of all the restrictions, then they become more intermediaries. Are you collectively, the four of you plus others, are you prepared here to take on and grow in this market? And where do you see that occurring? Mark?
Well, with the help of your well-capitalized audience, yes. Look, that's exactly what we're equipped for. That's what we're purpose-built for, which is to provide a matched solution. At the end of the day, most crises, we started this conversation in this world of the credit cycle, a term people are very fond of, and of course suggested some sort of abstract thing that exists independent of an ecosystem. It's not. It exists in an economic system, and if you have a recession, then you have more defaults, and then those defaults, in the case of liquid markets and the weak documentation, translate into big credit problems for the people that are lenders, and I think will turn into perfectly viable and attractive outcomes for many of the private lenders. But in any case, the key to me in this whole system, I guess, an opportunity, is to continue to shift capital from a system that has one-day money to a system that has permanent capital. Our firm, 92% of our business comes from permanent capital. So we have the opposite of the mismatch problem. We have long-duration capital to provide long-duration solutions, and that's inherently stabilizing. So that shift from the banking system, where the government has to stand behind it, where taxpayers have to stand behind it, into the hands of much less levered, much longer duration pools of capital, is a really positive development for the economy. It's a really positive development for the credit system. It isn't going to solve every problem. No single solution solves every problem. But I think that 10 trillion gives us, I just had a meeting this morning, I loved this phrasing. It was the head of CPP, and he said, it's the direction of travel. And I think that this element of growth in private solutions as part of this grand $7 trillion market is the direction of travel.
Well, obviously, de-risking the system that's borrowing short and lending long provides a number of positives and risks. But when you talk about you're making loans to 500 out of 10,000 or 2 to 5% of what percentage would you say you are today of what you look at versus what you decide to invest in?
Probably 3 to 5%, depending on the year.
So to lend money to small and medium companies below these levels, you're going to need some form of securitization. What percent of your portfolios would you be buying securitization, whether it's CLO structures, car loans, or other types of things?
Well, I think, a lot of reference to the structured risk transfers. I think that's a significant part of the market, right? As you think about the supply side, we talked about the speed at which that transfer of liabilities or debt to kind of the asset management or our client's world is really a policy decision, right? How fast these things are implemented, how quickly they are deleveraging. I think some banks are going to be caught with regards to they need to kind of just deleverage based off of their underlying structure or deposit base. Other banks are going to optimize their balance sheet, and a lot of those, from an RWA standpoint, can get achieved through these structured risk transfers. And so I think that is a market that is going to grow because in many cases, these are good assets on banks' balance sheets. They just may not have or want the level of leverage that exists in relation to the size of the balance sheets and the 23 trillion of assets on the bank. So, as you think about those risk transfers...
And there's even larger assets on the books of the Chinese banks than the U.S. banks, right?
Yeah, and Europe. There's like 29 trillion in Europe. But when you just think about that, right, a lot of what we have done and talked about on the direct lending side, we're investing and you're ramping up a portfolio that is going to provide yield over a period of time. Some of these risk transfers over the next couple of years will allow our clients to kind of really complement their portfolio and look at things like auto loans or fund level financing loans, but giant pools of assets that they can tranche up and buy different risk portfolios and really complement their overall fixed income. So it's really not private credit anymore. As broad as the term fixed income is going to be the private debt markets. It's going to be across all of that.
All right, so we have just a couple of minutes left. I'd like to ask one last question with very short answers. What keeps you up at night? Why don't you start us out? What does anything keep you up at night as, overlooking, billions of dollars of assets for others? Is there any fear out there that you have that?
Yeah, deficit creep.
Excuse me?
The deficit creep.
The U.S. deficit.
Yeah.
Mark?
I'll add to that. U.S. deficit's definitely geopolitical risk. The markets have never been good at pricing it well, and there's plenty of it in the world.
I have a lot of fears. No, look, when all of us have growing businesses, and if there's one thing which keeps me awake, as you scale, scaling is just as hard as shrinking. The processes you create to kind of scale, the investment teams you build, how you plan the transformation of your business into a permanent business, in all that, we find as a firm, it does keep me awake.
I would say, when we think about risk, we think about probability and convexity and magnitude of those things. And I'm going to add on with regards to Mark on geopolitical risk, but the derivative of that, right? It's not just solely the geopolitics, but the probability of events is increasing. And the derivative of that. And so it doesn't necessarily mean that an escalation of a war or something like that, or a conflict, but it also could mean that local policies are starting to become far more competitive. And so, the shifts on how we might think of the flow of labor or flow of goods can really impact the levels of inflation and therefore policy, and really change risk premium volatility in the overall market. And so those are, I would call it probably the bigger risks that I worry about today.
Well, thank all four of you for giving us insights, not only on how you feel about markets, but how your firms operate, and the fact that, surprising maybe for many of you, only a small percentage of everything you look at, you invest in. So thank you very much today.
Thank you.